afternoon, folks. It's Dave Burrows, Chief Strategist at Barometer Capital Management. I'm on my own today, but looks like I got lots of friends, lots of participants today, lots going on in the market, and certainly lots of things to consider. Just to kick off, wanted to start, as we always do, sort of from a high level. It's obviously been a very tricky market, lots going on, concerns around the financial services sector, which in some ways is muscle memory going back to 2008, which in the scheme of things is not that long ago. And I think the first thing just to remember on that point is that this is an industry that has become more and more regulated. Certainly, Silicon Valley Bank Corp was an outlier. Certainly, it raised concerns about the whole of the regional banking sector and some of the vulnerabilities around deposit base. But that being said, the capital bases are in a very different position today than they were in 2008, but we'll talk about that as we go along. Just as a reminder, we're not trying to mimic a market return. Barometer is all about trying to target and be tactical. Our job is to try to use the tools that we have to identify the areas of the market that have some kind of a structural tailwind. Especially relative to the rest of the market. We don't need to be everywhere. We need to be areas of market leadership. And we define market leadership as being parts of the market that are seeing net new inflows of capital, that are the beneficiary of some of the structural changes that are taking place. And that can be specific themes or sectors or geographic regions, or even asset classes, one versus the other. But our job is to try and find those areas and focus our attention in those areas. We have to continually stress test the portfolios to see, is there new leadership emerging, or are old leaders starting to deteriorate? Do we need to do things to shift the portfolio? In the absence of leadership, the number one focus has to be being prepared to play defense when it's required. And sometimes your gut doesn't tell you the right answer. You need tools and process to try to understand what's happening under the surface. There's always news flow, good and bad. There's 1,000 moving parts in this market. And the upshot is what is happening as a result of that news, not necessarily the news itself, because we know markets discount news generally ahead of time. And by the time things are happening, they've been largely discounted in. So this is a very tactical approach. We're not trying to be everywhere. And just to go from the top, as we have now for the last 3 years in doing these webcasts since the pandemic began, we continue to believe that equities as a whole, as an asset class, continue to be in a structural bull market. The S&P 500 has been able to maintain a stance above this rising 200-week moving average all the way along. This last box here is the period from the end of December 2021 through the current. So that's about 15 months. And if we were to mark it down, the S&P is down about 17% over that period. At the worst point, it was down 24%. That was October. And I know it feels tough, but the market has been showing signs of healing internally as we've moved along. There's certainly some really weak pockets. There's some areas of the market that on a relative basis are actually much better off. And our job is to find those places. But these kind of corrections, whether they're just sharp and short or more drawn out and long, are natural in a structural bull market. They happened all the way through the 80s and 90s. And they're very different than the bear markets we see in structural bear markets, where we're crisscrossing back and forth in broad swaths across this long-term moving average. And of course, this is what everybody worries about, because nobody wants to live through a 3-year bear market where the market gives up 50% of its value. The thing to remember is that in order to get from down 25, which would be a typical bear market, to down 50, there has to be some major systemic crisis that drives the second leg lower. And it's not to say that that's impossible from here. We're watching every day. But at this point, we don't believe that there are signs in place that is where things are going, because the market is quite bifurcated. There are some strong parts and there are some quite weak parts. We from a big picture view think that we saw generational low in interest rates in 2020, much like we did in the late 1940s. And we believe that rates probably move higher in fits and starts from here, probably for the next 15 or 20 years. We've moved into a world where inflation is hard to beat down. There's a lot of debt in the system, which is going to make it tough for the Fed to really, really crank the screws on Fed funds rates. And what they've shown over and over again, when a crisis arrives, they're very quick to push money back into the system, which means it's going to be hard to quell inflation. So that means the things that work are unlikely to be the things that worked during a disinflationary period, and more things that worked in an inflationary period. I like to point out that from 1950 to 1966, against rising interest rates, we had one of the greatest bull markets in US stocks in history. But it was largely driven by dividend growth stocks, because as rates rose, people needed a rising stream of income to offset a higher cost of living. And that likely is the place that we're in today. When we look at the 10-year Treasury yield, it fell very steadily for 40 years and has reversed and has been holding well above that long-term trend. Rates have been sticky. When we look at the TLT, which is the US long Treasury ETF, this has not been a great place to hide. Very often, we know that when the stock market's sloppy, the bond market's the place to go, to hide. It's a safe, secure place. But increasingly, investors around the world are avoiding treasury markets because they get hurt when rates go higher. The Chinese, that were one of the very largest holders of treasury bonds, have largely sold their entire position, as have other sovereign countries. And this is a problem. They recognize that there may be a headwind for bonds for a long period of time. That doesn't mean you can't put money in short-term bonds to get a little higher yield while you're sitting on cash. But as a longer-term investment, the period between the 50s and 60s generated a 0% return, inflation adjusted, for bond investors, a 0% return over about 20 years. So we think that this is early days. We're in a bond bear market, and this is likely to go on. We're going to need other sources of income. And the muscle memory is for people to say, well, I'll just go put it in the bond market. That might be tricky. If we compare the S&P versus the TLH, which is the long-term bond ETF, on a relative basis, for many, many years, stocks have outperformed, and they continue to. So even though we've been through a stock bear market, the stock index has been outperforming the long end of the US bond market. So if this were to break down, that might cause me to think maybe we're shifting from a large picture perspective, but equities continue to be a place where we want to have some exposure. When we look at commodities, other big asset class, we know they go through long periods of outperformance and then long periods of underperformance. That's a secular bear market that went on from 2000 to 2020. This is a broad-based basket of various commodities, including energy and metals and grains and so on. We know over the last number of months, after a sharp run up through 2020, 21, and the early part of 22, note that for 5 months, while the stock market sold off, commodity prices continued to move higher. They have corrected over the last several months and sort of worked off some of the overbought condition. But when we look at the Goldman Sachs Commodities Index versus the S&P, it broke out of a long bear market. That's the commodities versus stocks. We got extended above the long-term moving average and have corrected back down into it. But my guess is over the next while, it is likely that we're going to see commodities start to outperform stocks again. So why do I say that? Well, if we look at the individual commodities, some of them are quite interesting. I've put this picture up a few times. This is the long-term price chart of gold. And same thing, it goes through long bull markets and then long periods of underperformance. And it made no progress for effectively 10 years between 2011 and 2021. We broke out, consolidated, and in the last month have now broken above this range. So I've been asked quite a few times on these calls over the last few months, what do we think of gold? We are not gold bugs. but we're open to the idea that this asset class could be a good place to be in a more inflationary world, or in a world where the Fed and other central banks continue to print money and prove that they can't be tight. And we've seen gold break out of this cup and handle. So I think that that's very, very bullish. We put this up on Twitter. This is gold versus the S&P. Again, long outperformance from 2000 through 2012. That was gold outperforming during a structural bear market in stocks. And gold underperformed from the beginning of the bull market in the S&P until recently, when it just turned higher and broke this trend. So we do think that there is some regime change taking place, not just in interest rates, not just in, which types of stocks are working, but in the asset class, commodities versus equities. And we've said for some time now, we believe that going forward, it's possible that commodities are the stronger asset class. They are produced in a finite quantity. It's hard to put new production into play in a short term, on a short-term basis when demand picks up. We know central banks around the world have been buying gold. Sadly, our Canadian central bank is void of gold. But we know that the Chinese and the Russians and Brazil have been buyers of gold in large quantities, and it may well be they're preparing to try and have a competitive currency to the US dollar, something to keep an eye on. But gold certainly has made a turn. If we look at broad-based commodities versus the bond market, again, commodities broke out versus bonds in 2020. They've consolidated over a few months, which feels like a long time in people time, but in market time, it really isn't. And my guess, again, is that commodities likely over the next couple, 3-4 months, break out versus the bond market higher, which is why we've maintained a much higher exposure to the index in commodities versus other groups. So a lot of this has to do with what's going on in the US dollar. The US dollar is seen as a safe haven at a time of trouble. It's also seen as a place to go when rates are ratcheting higher. And we know that during the bear market in stocks, the US dollar rallied sharply versus the pound and the euro and the yen, and of course the Canadian dollar and the Australian dollar. As the markets put in an initial low in October, the US dollar started to sell off. Now, is this the chicken or the egg? Well, US dollar sold off as the stock market improved into December and then into February. And then we saw the US dollar bounce. We had broken the 50-day moving average, the long-term trend, the support level here at 105. We broke the 200-day moving average. And after dipping considerably below the 200-day moving average, rallied. And during this period, we know the stock market pulled back. Month of February, very tough month for stocks. So this is where we were 3 weeks ago when we looked at this chart. Here's where we are today. Our view was that it was going to be difficult for it to regain its strength. It got to this point where it broke down and below the 200-day, and the strength failed. And the US dollar has been selling off since. During that time, the euro is rallying, the Japanese yen is rallying, the British pound is rallying, and some risk-oriented assets are acting better. So this is an important thing to watch, but my guess is US dollar probably continues to weaken, and it's signaling perhaps that the Fed may be done with their rate hikes. And that can take some pressure off some risk assets. Now, we all have our opinions, and we can't make decisions based on those. We got to have tools that are repeatable, processes that are repeatable. In our view and our research, it would say that 70% of return in an investment portfolio comes from getting to the right neighborhood, being the asset classes that people care about today. So to back up, commodities, equities, maybe global equities, which we've talked about over the last few months. 70% is getting to the right areas. 30% is finding specific securities within those groups to express your view. So we spend a lot of time on the macro. That's my focus, trying to understand the macro landscape. What is it that's working and what isn't? We try to identify those sectors or themes or geographic regions or asset classes. And then our research team does a lot of work drilling down through 60,000 securities, trying to identify specific securities that are good, getting better, both fundamentally and technically, within these groups that we're talking about. So we can find securities that are good getting better, that are within groups that are seeing net new inflows of capital. That's where our portfolio should live. And recognizing that the world is a dynamic place and is a living, breathing thing. The most important part of this whole process is having a disciplined selling strategy to recognize when maybe we've made a mistake or when something's changing, either for the better or for the worse, so we can reposition our portfolios. So the top-down work is all about finding areas of the market that are showing expanding breadth. And I've raised this over and over and over again. You can find a great security at the wrong time to get your tail shot off. You need to know that there's a wind at your back. And when we look at a sector, we want to know that over time, if we're invested there, more and more securities are participating in the strength. The market rally is broadening out. That's constructive. When we're in a group and we start to see deterioration in breadth, meaning the weaklings within the group start to roll over. It doesn't mean we sell everything, but it means we stop putting any new positions on. It means we tighten up the stop losses that we use on our existing positions, and we stop putting new money to work. So if this is at the market level and breadth is contracting, and we're being stopped out of positions, we sit on our positions, we sit on our cash. So let's talk about the market as it is today. This is the S&P. And again, it's a longer term chart. The pink area is the end of the secular bear market in 2013. These are the recent bear markets we've seen over the period, all the while staying above this 200-week moving average. If we look at the shorter term picture, this is the most recent number of months. So this is from the beginning of 2022. And yes, it's been a tough market. But it's really important to recognize that when markets are discounting bad news, it doesn't happen all at once. And there is no magic moment where things go from good to bad or bad to good. We saw an important low in June, the market rallied and failed. We made a lower low in October. And so far, that has been the low for this bear market. But it doesn't mean things turn and go straight higher. We get bouts of good news. Maybe inflation starts to back off as it did in the fall, or it starts to pick up again as it did in the beginning of this year, or the fallout from Fed raising rates start to impact certain institutions like Silicon Valley Bank Corp. And the market is emotional. But what's important to see is we put in a low in October, a higher low in December, a higher low recently. We broke this downtrend or the downtrend in the market. We came back and we retested it. We sit today above the 200-day moving average. We sit above that trend line. We put in a series of higher lows. And until that changes, we believe we are in a bottoming process in the market. And the reason it's so important not to just go and blow everything out and go to cash is that what comes after bear markets are long run-ups in price. And we cannot guess at when exactly it's going to start. But within the index, there are going to be groups that show their hand. Groups that either held on longer before they started to decline at the beginning of the bear market, like say basic materials did, or groups that bottomed earlier or have done better since the lows. And our job is to try to identify that. Now, internally in the market, we know that breadth has been weak now for about 6 weeks. Two things happened this week in our short-term indicators. We looked at this 3 weeks ago, the percent of stocks with positive weekly price momentum. This is a percentage reading on the axis, on the x-axis. So we know that through the course of recent months, the percent of stocks in uptrends, with positive weekly momentum had been backing off. If we go back over the last several years, we highlighted this 2 weeks ago, when you get down to these levels is where generally we start to see some improvement internally in the market. And that's what we've seen this week. We've seen 6% of stocks reverse and have some upward trajectory. Doesn't mean everything. And our job is to find those areas. The second thing that we saw is that the percent of stocks trading over their long-term moving average, their 150-day moving average, also found a low and reversed higher. Now, in October, when the market made its low, only 12% of stocks were above the 150-day moving average, and it turned higher. Market rallied through November and into December, and then it pulled back again. So as we sit today, now we're in a column of X's, which means that the percent of stocks above their longer term moving averages is expanding again. So these things don't happen all at once. 2 of our 4 short-term indicators have turned up this week. We've yet to see a shift in the basic indices, or the percent of stocks in the US, the percent of stocks in Canada, the percent of stocks globally that are in uptrends. And while we wait, we sit on cash. We are not really putting on new positions. Let's talk leadership. When we were sitting in October, you can see that on a distribution curve, all of the sectors of the US market were piled up down here on the left-hand side with a very small percentage of stocks in uptrends. The average group had 24% of stocks in uptrends. When the market was at its highest level so far for this year, at the beginning of February, you can see that percent of stocks in uptrends across these groups had broadly moved to the right, meaning that lots of stocks were doing better. And we got tested again over the last month and a half. As we sit today, it looks a lot different than October. And it certainly pulled back from the beginning of February. But we know that the market internally is behaving better than it was back in the summer and fall. Importantly, semiconductors as a group turned higher. It's a highly economically sensitive group. It's an important group for the market because it's short inventory cycles. We know very quickly when demand picks up or demand slows down because the orders disappear quickly. Nobody wants to sit with expensive semiconductors in inventory. What else is important? Wall Street as a group. This is the capital markets banks, JP Morgan, Morgan Stanley, et cetera. In capital letters means it's having expanding breadth. That's positive. What else can we take away? Well, today, after this chart was produced, the oil sector and the precious metal sector turned higher, meaning the percent of stocks in uptrends expanded quite dramatically today. That's positive. The groups that have been leading have been industrials and basic materials. We've talked a lot about that over the last couple of years. And this is where we're seeing strength. So let's just take the groups one by one. Industrials, I put a low in October, a higher low in December, a higher low here at the end of March. When we look internally within the group, the aerospace sector is one we've talked a lot about, a series of higher lows. Again, this is a process. But over the last 13 trading days, again, tested that December low, held, and have rallied off it. So that includes companies like Lockheed Martin, General Dynamics, the defense stocks that we talked about. It also, if we look at the industrial group, includes a lot of the automation companies. And we've talked a little bit about ATS Automation as being one of our big holdings. This is a list of mid-sized industrial equipment companies. Again, June low, a higher low in September, higher low in December, and a higher low in March. This theme continues to be valid. Bombardier, one of our biggest holdings, trading very close to all-time highs. Business jets continue to be a good business. When we look at materials, similar picture. Again, it's not a straight line. October low, higher low in December, higher low in February, March. And within this group, we've seen some real strength in steel. This is a group that you would expect to get hurt if we're going to have a steep or deep recession. Probably gets helped by infrastructure spending in the US, probably gets helped by the fact that supply chains are being reworked. There's less steel coming from China, more steel being bought straight out of the US, and pricing remains pretty strong. Metals and mining group, 12% of stocks in uptrends in July, 18% of stocks in uptrends in October, 40% in December, 46% of metals and mining companies in uptrends today. This is a slowly improving process. So I know it feels like this market's taking a lot of time. And it's not to say that the news couldn't get worse and the market might react to it. We watch that. The gold miners as a group are acting very well. The GDX gold ETF, which is made up of some good companies and some bad ones within the group, has been on a tear over the last 3 weeks, while the market has been kind of sloppy. If we look at the gold producers versus gold itself, it's rising. This is typically a sign of of strength in the group when the producers start to outperform the metal itself. The GDX was up about 3% today against a market that was down. Well, I guess the NASDAQ wound up down only 30 basis points. S&P was down marginally. Within this group, of course, we're looking for stronger names. Wheaton Precious Metals, which is a streaming company, gets royalties, acting really well. And AGI, Alamos Gold, is a Americas-based gold producer with many different deposits and areas of production. It's a particularly low cost, long life asset, and today made new 52-week highs. So there are things to do in this market. When we look at the home construction materials group, a low in June, when the market made its low in October, it was making a higher low in December, and making a substantially higher low today. Again, a group that shouldn't do well if we think we're going to have a hard landing. Now, one group that's been improving and is becoming a bigger piece of our portfolio after being out of the group for over a year is the tech sector. Now, I'm not talking about the broad-based tech sector, because there are lots of companies that are not doing well. Many of the companies that we've been focused in are companies with very, very strong cash flow and have been generating really substantial dividend growth, which is really where the strength has been, the largest of the large cap tech stocks. Now, I don't know whether this continues, but this doing exactly what it should do. A low in October, a higher low in December, a higher low when the market's testing in March, and trading really at highs not seen since early last fall. So that brings me to the financials. And the financials have been a real tough sector over the last little bit. This has been an important group for us. Again, all things don't act the same. Within the XLF, we have banks, we have insurance companies, we have brokers, there are financial payments companies. There's companies like Berkshire Hathaway, which are diversified, but the sector certainly got hurt. Relative strength for the sector rose from July until February. And when we could see, when Silicon Valley Bancorp got into difficulty, the group sold off. So the first thing I'll say is it's important what you own within the sector. And second, if you own something that isn't working, it's important to use stop losses. The regional banks really have been the place that have been damaged the most. Silicon Valley Bancorp right at the top of this list, First Republic right below it, both were in difficulty. You can see this sell-off. Now, I got asked on BNN about Silicon Valley Bancorp about a month ago or 6 weeks ago, as is this one that people should take a look at? My comment was, look, you have to look at their constituency. Silicon Valley Bancorp is the bank to the tech industry. The tech industry has been through a significant bear market. If you're a venture stage tech company, you're probably not raising money. You're probably using your deposits to pay out your payroll, and probably not a great place to focus. And so thankfully, we had no exposure to Silicon Valley Bancorp. If we compare the big banks to the regional banks, this is a relative strength chart. You can see since October, very clearly, the large banks have been way outperforming the regional banks. Let's drill down a little bit further. Let's compare Royal versus the large banks ETF. So large banks doing better than regional banks. Now let's look at our holding, Royal Bank versus the big banks. Look at the relative outperformance. This is all about owning quality. If we take a look at the, and I didn't put it in here, JP Morgan versus the big banks looks exactly like Royal versus the big banks. Royal and JP Morgan have very, very diversified deposit bases. They have solid assets that are diversified geographically. And the relative performance of these large, high quality banks has been way and away better than the regional banks. Let's look at insurance, because we've talked about how insurance is roughly 50% of our exposure versus the sector. KIE, which is the insurance ETF, versus the large banks ETF. Insurance has acted much better than the large banks. So while the sector has had difficulty, if you're mining the highest grade material or going to the best companies, likely you did a lot better. And so we've been fortunate not to get hurt really in the sell-off in regional banks. We did stop out of a couple of smaller banks that we had earlier in the winter, and we've gone through this period just with the highest quality, safest banks that you can find. There's Fairfax Financial, one of our biggest insurance holdings, versus the XLF, the entire financial sector. Again, very strong outperformance. So what is it that has not been working continually? Well, it's been high dividend payers, and it continues. Utilities continue to underperform. Real estate investment trusts continue to underperform. High dividend payers with very little growth. These are the things that do well during falling rates. As we talked about at the beginning, you don't want to own things that did well during falling rates. You want to own the things that do well during rising rates, and real estate, sadly, is not one of them. High dividend paying shares. This is the SDIV, which is a global super dividend ETF made up of companies with the highest dividends. They have not been a place to hide going through this period. So some of the places that you might have thought were the place to be defensive through the course of the last 15 months of a bear market have definitely not been the place to hide. Bonds were down as much as stocks. High dividend paying shares down way more than the market. Recently, we've seen some improvement in very short-term treasuries as rates backed off, as the Fed showed its willingness to support the banks. Money flowed into short-term bonds, and we've talked about having 25% of our holdings in short-term bonds. So if we put it all together, financial still makes up 20% of our overall portfolio, but I would argue they're high-grade positions, and we have about half of it in banks and half of it in insurance companies. Technology has come up in size. It's still a significant underweight to the index, and specifically they're in dividend growth stocks like Microsoft, for instance, which has been performing really well. We highlighted NVIDIA and Advanced Micro Devices last week on the call. And industrials continue to be a significant across all of our portfolios. And this is a play on the industrial renaissance in the US and the re-onshoring. Government bonds are largely very short term, less than 1 year in nature. It's a place to hold cash. Materials continues to be a pretty significant overweight, but it's a small group within the market. Energy is a slight overweight. Corporate bonds are about a 5% weight. We got some cash. So the portfolios have approximately between 20 and 28% cash and short-term bonds. We have nothing really in the defensives, almost very little in utilities, very little in real estate, very little in consumer staples, very little in healthcare, and very little in consumer discretionary. So the portfolio continues to be built for a more inflationary world. We're trying to keep some powder dry so we've got money to put to work when our indicators turn up. That could happen at any time. If things hit our stops, we're going to continue to raise cash. And I guess when we look at outside the US, it's important to recognize that stock markets in other places are doing better. This is the European Stocks 50. It made a low in September before the S&P made its low in October. The relative strength versus the S&P has been improving ever since. And this is even with the Credit Suisse difficulties and concerns around Deutsche Bank. The Japanese equity ETF, EWJ, has been performing well now, actually being helped by currency, and the Japanese yen is improving. This is the EWW, which is the Mexico ETF, again, making substantially higher lows. So there is some strength in this market. Even some of the cryptocurrencies are acting better, Bitcoin and Ethereum. It would make sense that they may do better as gold is doing a little better, as there is concern around, central banks being willing to continue to print money. So in our macro portfolio, this is a diversifier. This is something that acts unlike a stock market. 34% of the portfolio is in precious metals related securities, 25% industrials, which includes machinery and aerospace and defense. We've got 22% cash, that's dry powder. We've got positions in commodities and Bitcoin and Ethereum. We've got an energy position and some materials, and then a bunch of global securities. On the short side, we are short the US dollar. We're short US large cap. We're short real estate and fixed income. And we got a small short position in regional banks. So look, nobody needs us to replicate what the S&P 500 does. We need to be invested in the big structural themes that will benefit going forward. And slowly these things reveal themselves to us. From a volatility perspective, this was volatility in the COVID sell-off. Volatility is sitting at fairly normal levels. And credit spreads continue to be benign. So look, I know it's scary when we read the news. We read about what's going on in the Ukraine. We read about what's going on in some of the weaker financials. People worry about, the death of the US dollar. We can invest in ways that avoid some of these issues and take advantage of some of the areas that have a tailwind. We continue to think that the S&P is in a structural long-term bull market. And nobody's going to ring a bell when the sell-off is done. So we have to stay in stronger areas, avoid the weak ones, and have some cash and flexibility for when the time comes to put more money to work. If things get more difficult, we will get more defensive. But with that, maybe I can look and see if there's any questions. This is what I missed, Pamela. I got a question here. How would you compare Bitcoin and gold as investments given market conditions? Well, let's take a look at that. Okay, well, we don't need to have all this stuff on the screen. So it's something that I look at, and this is, I'm just going to put up, let's see, this is Ethereum versus the S&P, which is interesting. There's a relative strength chart that shows how recently Ethereum has started to strengthen versus the S&P. But let's look at Ethereum USD versus gold. So you're going to see that actually in the last period of time, while gold has been improving, Ethereum and Bitcoin have been improving more. So this is the relative lows in July and June, a higher low in October, where we are today. If we were to compare Bitcoin, BTC US versus gold. Oh, that did not come up. BTC US. I'm not sure why that's not coming up. Oh, BTC, sorry, USD by gold. So it's the same picture. So Bitcoin is outperforming gold recently, although, through the sell-off while tech was getting hurt, it was a lot worse. So we have a relatively small position in our macro portfolio in Bitcoin and Ether. We have a much larger position in silver and gold and related securities. We are not gold bugs, but both of these are securities that you might like to own if the US dollar were to continue to weaken, or if central banks show they're going to continue to print money every time we have a problem. So look, these things change. As we sit right now, the market is evolving in interesting ways, and we just have to continue to do the work and watch for change as it comes along. Let me just see if we got any more questions. From an anonymous attendee, this is a good question. Was there a connection between the sell-off in oil prices and the banking instability? Yeah, I think that in many ways that there has been. I think that the price of oil has been dominated not just by, supply demand, but it's actually been probably dominated by hedge funds and people using it as a vehicle to express a view. But irregardless, I guess that's not a word, regardless, oil got caught up in it. There was a lot of long positions in the oil market when the financial services companies started to come under pressure. There was an unwind of positions. There's something called delta hedging, which is where banks were hedging out the positions that they had written in options. And this steep sell-off here in March likely was driven by the unwind of that hedging position. So we'll see. Technically, oil continues to have a bit of a sloppy look. And so I have to be careful. Now, when we look at the equities are acting a little better. Certainly we put a low in the oil service companies, say in July, a higher low in October. We retested those December lows and have held so far. I think that's a positive. We look at the large cap energy names, XLE, they did break the December lows, which is why we have a substantially lower weight today. There are companies within the group that are acting better. Hess is a favorite of ours. I don't think I have that on the screen here. So it's trading back above the 200-day moving average, but certainly it got caught up in that sell-off. So, it's a work in progress. I put something up on Twitter today. It's interesting. If I look at XOP, which is the producers ETF versus the S&P, let's even go back and compare it to the NASDAQ and look at it on a long-term basis. It's interesting that, on a relative basis, energy, there we go. Let's look at it even longer. So energy producers went through their bear market from 2015 through 2020 and started to relatively outperform the NASDAQ and outperform the S&P. We broke the long-term trend. Well, we got extended away from the moving average and the trend line, and over the last 5 months, we've pulled back. It'll be interesting to see if energy can make a stand here. If we look at it on a weekly chart, it's trying. So I really use energy equities as a better tell on the energy industry than oil price itself, because in the end, we're investing in the longevity of these businesses, not the very short-term vacillations in the nearest term futures contract. So this is something for us to watch, and I'll keep posting this stuff on Twitter. But if energy as a sector is going to hold here, this is where it should happen. And certainly, the energy service companies were up, I think today, let's see, about, well, it's 5 year. So they were up 2.55%. They were up 5% yesterday and up about 1% the day before. So, they're trying to hold here at the longer term moving average. We'll see whether it can get going. Let me just check and see if we got any more questions. I got a question on copper. Do we think that copper will be a short supply in 2023? And why is price not indicating a shortage? Again, remember that hedge funds use economically sensitive securities to express a view. If I look at the copper producers sort of held at some support recently. This is the COPX copper producers index. If you look at some of the smaller cap securities, like, we've talked about foreign mining, definitely got extended away from the 50-day moving average and pulled back in, but that's a very constructive chart. I think that there's a number of mid-sized copper companies that look quite interesting. And yes, we do think that copper is going to be in short supply as China's reopening. They've drawn their stockpiles down to very low levels, so they're likely to start restocking. And I think that's all the questions we've got. Look, I appreciate everybody tuning in. I hopefully we answer some questions. If you got questions that we aren't answering or topics you'd like us to cover, please send us an email or give us a call. If you're too shy to do that, just send us an email and we'll try and answer it for you. But we'll see you again next Tuesday. And thanks for tuning in.